CrowdStrike just reported their earnings and the stock is trading sideways. It's currently trading at about $151 with a market cap of about $35 billion. In this video, I'm going to cover their recent quarter earnings and I'll do a valuation in the end. Let's look at the latest quarter earnings. They made about $692 million, which represents a 42% increase in revenue. The gross margin is about 78%, that's for the subscription. And the GAAP loss from operations is about $19.5 million. CrowdStrike has about $3 billion of cash equivalents, and short-term investments. Let's look at their guidance. For the full financial year of 2024, they're guiding for close to $3 billion of revenue, which is actually an increase from the previous guidance by a small margin. It represents about 34% year-over-year growth. Let's quickly look at the income statement before we do the valuation. As you can see on the screen, they made about $692 million of revenue in the most recent quarter. Out of that, subscription contributed to about $651 million and professional services fetch about $41 million. And look at the gross profit, it's about $523 million. So that's only 75% gross margin. This is impressive number, but CrowdStrike reported 78% gross margin, but that's only on the subscription, not on the professional services, right? So the overall gross margin is about 75%. Gross profit is about $523 million, whereas the operating expenses are $542 million. So when I deduct $542 million from $523 million, I get negative $20 million. So that's their operating loss. And when you look into the weighted outstanding shares, in the most recent quarter, they're saying they will have about 241 million, and a year ago they had 231 million. So they diluted us by about 3.8%. In full disclosure, I do own CrowdStrike. I started buying at about $123 and I added in the 140s. So my current average cost is in the 130s. Let me now show you a valuation to determine what is the upside from the current $151 stock price. This is the screenshot that I have shown in my previous video. As you can see on the screen, I estimated a growth rate of 25% year over year for the next 5 years. This year, they're saying they can grow about 34%, right? And as the company gets bigger and bigger, it's hard for them to grow. So the growth rate will fall down. And that's why I assume 25% year over year growth for the next 5 years. So which will fetch them about $6.8 billion of revenue in 2027. This fiscal year 2024, they're saying they can get $3 billion, right? So I'm assuming that they will add almost another $4 billion in the coming 4 years. So I think this is reasonable. Just because the net profit margin, I'm assuming 25% based on their 75% overall gross margin. Typically companies with 75% gross margin in the SaaS sector have 25% net profit margin. So that is the basis for that number. With that, they will make about $1.7 billion of net income in 2027. For a company that's growing at a 25% range and has a 25% net profit margin, I can comfortably assign a multiple of 25, but I'm giving it a premium of 27.5 multiple, with which this company would be worth about $47 billion in 2027. With respect to the number of outstanding shares, we do know they have about 241 million outstanding shares now because they are diluting the shareholders. They do give stock-based compensation and do not buy it back. On top of that, they're not profitable yet, so the dilution will continue to go on. So with 2% dilution, which I think is actually optimistic, in the most recent year, they diluted us by about 4%. So 2% dilution, in my opinion, is optimistic. They're getting close to profitability. That's why I assume 2%. With that, they will have about 259 million outstanding shares by 2027. When I divide the $47 billion of market cap with 259 million outstanding shares, I get a stock price of $181 in 2027. Currently, they are at $151, right? So that's about 20% gain in 5 years, which is not attractive. When I have shown this valuation in my previous video, I got some feedback that the multiple of 27.5 is too conservative. Typically, for my investment journey, I cannot pay more than 30 multiple, but just for the sake of the viewers, I did another valuation. All I did was changing the multiple to 35, which I think is a rich multiple for 2027. So if people pay 35 multiple, This company would be worth about $60 billion in 2027, and that will result in a $231 stock price. Current stock price is about $151, right? So that's about 53% gain in 5 years, which will beat the index. But for me, I doubt whether people will pay 35 multiple in 2027. That's about 5 years away. A lot of things can change. Competition can catch up, and cybersecurity is a growing sector, but there are a lot of players in this sector, right? So I highly doubt whether they'll get a 35 multiple, but if you think 35 is reasonable, that is fine. But for my investment journey, I'm going to base it on the $181 stock price, and for me to get a 50% gain, the stock price should be in the 120s or 130s. So that's why at $151, I'm not adding. I did add at $140 stock price before, but my average cost is still in the 130s, and I want to keep it like that. So anytime it goes into the 130s, I will add to this company because this is a quality company. Do remember that they still have a price to sales of 14, which is extremely rich. Price to sales of 10 is okay for companies like CrowdStrike, which are growing rapidly and have a moat. But price to sales of 14 is actually very expensive. So we have to watch out for that price to sales multiple as well. People will not pay 14 even in 5 years, right? So it has to come down. The hype will cool down in 4 to 5 years. So I recognize that $151 has a price to sales of 14, which is extremely expensive. So that's why I will only add when it gets to the 130s. Thank you so much for watching. Let me know your thoughts in the comments.